Hello everyone, we are live from Chicago. Today is Thursday, September 12th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are extra glad you are here with us tonight. This is the month of September, and always remember September. We're going to actually drill down into this for the first time as to why this month is so hexing. All right, so here are our topics. You guys know these. If you watch the show, we're going to cover most all of these. It's going to be interesting. If you are new to the program, please subscribe to us on YouTube. Click the little bell and you'll get notified whenever we go live or when I upload a video of special interest that might not be live, but I want you to see it. Also, subscribe to us on Facebook, X, and LinkedIn. We tweet every single day, and we hope that you'll check out those as well. And for 2.5 months now, we've been really building some traction with our weekly podcasts. So I'm usually doing a live update, meaning I'm talking about the current week on Saturday or Sunday, and then Wednesday or Thursday we put out what we call an evergreen issue, which I hope is something of interest to you, so tune into those as well. The next show, Thursday, October 10th. We will see you for that as well. So the monthly market review, as I said, we're going to focus a little bit on September. I've had clients say to me over the years, why is it September gets such a bad rap? Well, here's why. Over the last 95 years, the S&P 500 has posted losses in September 53 times and produced gains only 42 times. No other month has that bad a record. In the last 96 years, we'll call it a century, the S&P 500's dropped on average 1.2% in September, making it the weakest month of the year for stocks. Now, I have to say, we're not off to a bad start for this September, but that's because it's an election year, which I'll talk to you about in just a few minutes here. All right, so there's several theories about this. Seasonal behavior, investors returning after summer vacations, assessing their portfolios and making changes. Mutual fund strategy. So many mutual funds in their fiscal year. Now, a fiscal year is any year for an entity other than December. That would be a calendar year. A fiscal year can end in the middle of the year based on their business cycle. And sometimes mutual funds want to do what's called window dressing, not in December, but in September because their year end starts on October 1st. There's also tax loss harvesting, also tied back to the mutual fund industry, and pre-positioning basically because of the same reason, anticipating this September effect. So it becomes a self-fulfilling prophecy. The election season throws in an extra little bit of unusuality here because the media blitz for U.S. elections can cause people to feel anxious about this potential power transfer or shift in Washington. And so this isn't limited to just the U.S., but certainly anything that happens in the U.S. in the economy or the electoral cycle affects the rest of the world. And then finally, market psychology. As I said earlier, self-fulfilling prophecy. Because people know that September is the worst month of the year, they tend to go in and sell because, well, why? Because everyone else is going to do that, all right? So here's what it looks like on the chart. Just the last 4 years, all of them down. 20, 21, 22, 23. We don't know about 24. That'll be revealed in the next 2.5 weeks or so. But if you look back further, a 30-year period, 5-year period, you'll see the blue minus 30.34 and then a minus 0.289. So you can see the months across the bottom. And there are other negative months, but consistently September is especially bad. And for all the reasons I just listed for you. As I said earlier, though, the presidential year, so this is every 4 years, it's every leap year, by the way. Look at the red dot in September. You'll see it's actually higher, but non-presidential election years, it drops to that -1 that I mentioned earlier. So May doesn't do very well in a presidential year, and it doesn't really do that well in non-presidential years, but certainly September is the worst. No question about it. That said, after Labor Day, look at how the rest of the markets do here. So the Dow, the S&P, and the NASDAQ, The worst period for each of those was during a bear market. 1987, that's a while back for some of you, 2008, and then 2000. But if you see the green, it's up by the end of the year after Labor Day, even with a bad September. And that's simply because we have 3 months after this, in October and November. Even though October has a reputation for some market turbulence, maybe some serious market turbulence, November is the second strongest month of the year after April. So that's what's up ahead. Why do I give you all this data? Because I hear the client calls that are saying, I just feel anxious. We go to cash. No, you shouldn't go to cash. We don't know what's going to be up ahead for September. And certainly now that you've seen this data, we're not concerned about it in an election year. So it's not just a U.S. phenomena, as I mentioned earlier. September is historically the worst month for equities across the globe. So look at the percent of countries with positive returns, and then look at the percentage of countries with negative returns. And again, just focus on September. It's the worst, all right? And again, we are the biggest game in town, and we influence all the other markets in the world. Never mistake that. You guys know this chart really well. It's the 100-year chart that I show you from time to time when you might be getting a little nervous about all the volatility in the market. Focus your eyes on the far extreme right end of the chart. We are right up there, just a few percentage points from lifetime highs. Although when you see these big 600, 500 point moves in the Dow, all in the month here of September, I actually had a few in August as well. August 5th was a pretty crazy day. You begin to think, well, maybe this is the end. Well, it's not yet. And I don't know when the end is. And if I knew when the end was, I would take you all to 100% cash. But if I do that and miss another 8-9% upside in the market, that would be a disservice to you. So we trade by indicators, which we will talk about in the last section, which you all know because you watch my show every month, right? Okay. So on the 100-year picture, the proclivity, word of the day. Word of the day, proclivity. Okay, I haven't had a word of the day in a little while, so there it is. Yes, it means the tendency for something to occur on a periodic basis driven by a given set of circumstances. You guys know this chart, 498. I don't know why there's a typo there. It says 493, but 498 companies have reported. 79% is 6% above the 73% mean that I've been showing you on this chart for, 4.5 years now. Financials are higher, healthcare is higher, industrials, and look at technology. That's our biggest sector. So as technology goes, so does the rest of the market because technology is about 38% of the market. So if you look at the data, it makes sense to stay invested, and that's why we are. Okay. U.S. policy. Why is U.S. policy important? Because politics, which we all hate, leads to policy. And policy has a personal and portfolio impact. Here's the disclaimer on this section. This will be arguably the most strongly worded political section I've ever done. And it's because I'm fed up with the way things are happening in this election process. If you are a Kamala Harris fan, you will not be happy with this section. If you are a Donald Trump fan, you will not be happy with this section. But I am looking out for you. You are my folks. You are my clients. And I'm telling you like it is and what concerns me about the current environment just 50 some days before the election. All right. So in a season of craziness where we have an attempted assassination. A president resigns from the race. He appoints, without any election, his vice president. She goes on to swing the polls. And now Biden, in what apparently is a major gaffe, starts wearing a Trump hat, a MAGA hat at the 9/11 event just yesterday. Folks, I can't make this up. This is happening here in America. All right? So what is the main objection that's getting me so riled up here? I don't believe our major candidates are doing a service to you, the American public, the American investor who want to know facts. So how is it that we have these two people on stage and they behave, in my opinion, pretty much like sixth graders? All right, I don't know about you, but I sat there watching the debate the other night thinking to myself, surely we can do better than this. I mean, we have a candidate who literally refuses to hold a press conference month after month, and then finally gives one a softball news conference with CNN, finally gets on the show last night, or 2 nights ago, I should say, and David Muir asks her, so what do you have as a plan for the economic future of America? And her response is something to the effect of, well, we have a plan. It's a good plan. In fact, it's a great plan. And we're going to get our cabinet together and we're going to come up with this great plan. And then the American people will be shared this plan and everyone will see if it'll benefit all Americans. That's our plan. And I said to myself, are you kidding me? The next day, 20,000 restaurants in America have a new entree on their menu right below bruschetta and Cobb salad, and I can just hear them coming in to order this off the menu. I'll have the brand new Kamala word salad, extra dressing, hold the substance. It bugs the daylights out of me that we can't get anything from our politicians, and I wish it were just on one side. It's not. It's not at all on one side, but this is what bugs me about Kamala Harris. So then David Muir asks a question of Donald Trump, and he says, so speaking of immigration, what do you think? What is the problem? And Trump starts on a pretty good note until he gets about 18, 20 seconds into it, and then out of nowhere starts talking about illegal immigrants in Springfield, Ohio, eating cats and dogs. And at that point, I stand up on the edge of my couch and go, are you kidding me? You cannot be serious, man. You cannot be serious. 500 million people are going to be watching this debate over the next half a month or maybe even a full month. And you're talking about illegal immigrants eating cats and dogs. And when Muir asks you what your source is on that, you say you saw it on TV? Really? I saw My Favorite Martian on TV. I saw Star Trek on TV. Does that mean I put credence in that? The American public deserves better. So the next morning, here he is out there saving the kittens in Springfield, Ohio. And I guess that's what gave rise to a little kitty triumphant here that decided to stand up for all the cats in Springfield, Ohio. I want to introduce you now to the cat named Spike. Spike decided he was going to rally his fellow felines and stand beside them and free all of those that are in the animal shelters and keep them safe. Make Ohio safe again for the felines. I am really sorry I had to do this, but folks, I am just fed up with what we are hearing from our politicians. And now we return to our regularly scheduled program. All right, so which party is better for the economy? Well, Democrats' economic policies benefiting low-income and middle-income families. Okay, they argue that income inequality is what spurs economic growth. Okay, they need to reduce that. All right, I get that. Keynesian economic theory that the government should spend its way out of the recession. Okay, that's meaning that the government's going to be the solution. I don't happen to agree with that, but I understand that people do. Some very knowledgeable economists do. And some research shows that economic growth is better under Democrats, which we'll see in a few slides. Okay, on the Republican side, advocate for supply-side economics. That's the Ronald Reagan, supply-side economics. Pretty good times under Reagan, but not everybody agrees with that. Argues that tax cuts on businesses are important, allows them to hire more workers. If they're paying less in taxes, they hire more workers, they make more widgets, they create demand and growth. Makes sense, but that doesn't mean that the whole breadth of the population participates in that. Okay, so there's some problems with that, and that's why a combined solution makes a lot more sense. And they have a business-friendly approach, which makes many people believe that Republicans are better for the economy. All right, well, really? An investor who put 10 grand in the S&P in 1961 and only held when Republicans were president would have made 102,000 by the end of last year versus 500,000 for Democrat administrations. Does that debunk what they're telling you on the news? Sorry for those of you on the right side. I'm an independent. I will vote for anybody that is going to profess to implement policies that help my folks, my clients. That said, I have never voted for a Democrat in my lifetime, okay? Full disclosure, I haven't been real happy with the Republicans for whom I voted. But if a politician can suggest, and I can believe, that they want to implement policies that are good for my clients as investors, they get my vote. And that's why I'm independent. All right? If you stay fully invested in the S&P during this time frame, over $5 million. $5 million. All right? The Federal Reserve. Here we are, Jay. Oh, Jay. You and Jackson Hole and saying things up there, I don't know. But the market, whatever you say, and you and the rest of your Fed governors said, is now pricing in. This is in the futures market, which I trade. Okay, is pricing in 225 basis points of reductions by the end of 2025. I underline that, not this year. That's 15 months, not 3 months from now. 225 basis points is about a 40% drop. Look at the big black arrows I drew there for you. Okay, that is going to be a huge boost for the U.S. economy, for business loans, and especially for real estate. It's really hard to sell homes unless you have a primo location and people willing to pay cash that don't need to finance. It's hard to sell a home unless you have those two conditions. Now, when rates drop from 7-something to 5-something to 3.5-something, then it changes everything. So what we're seeing is consumer spending pushing against those hopes. Why? Because consumers are continuing, I should say, to spend. And the Fed is saying, well, okay, if they're spending, they must not be in too much disarray here. So why would the Fed want that? Well, they want to see the distress because then they can say, okay, now we have to loosen the screws on interest rates. But consumers have been resilient all during this rate hiking cycle. All right, that's just attesting to the strength of the U.S. consumer. And yet there are plenty of others that are saying, look, these rate cuts can't come soon enough. The labor market is suffering, excess savings are dwindling, and home sales are down. Well, we're going to get to that in just a little bit about the home sales being down. But look at the chart on the right-hand side. I know there's a lot of numbers here. All you care about is the 90-plus days at 8%. That's a lot of credit card balances getting to be overdue. And that's the concern. All right. Inflation, it's still with us, folks. It's just hiding. The Consumer Price Index was released yesterday, okay, showing a continued easing of inflation. That's good. That's what we want to see, but it's a mixed picture. And I want to explain this to you because I want you to understand CPI is a very critical component of how we make decisions for your investments, but it exists in multiple time frames. So stay with me on this, okay? I'm going to give you a good metaphor to remember how CPI exists in multiple time frames. So it increased year over year, 2.5% in August, down from 2.9. So that's good. We want low, all right? Marks the lowest annual inflation rate since 2021, but on a month-over-month basis, consumer prices rose. So how is that possible? Well, this is why. If you say that Chicago's in a drought and we get a downpour on a Tuesday and a downpour on a Wednesday, and you say, well, the drought's over. It's like, well, not really. We're still, average rainfall is 42 inches and we're at 16. We're still in a drought, but the short term is things are really wet and the plants are super glad about it. So when you see this data, what this means is that on a month-over-month basis, consumer prices are rising. Here's what it looks like on the chart. So the red bars are what you care about. In the very short term, we had a survey for the August Consumer Price Index. It was supposed to be 0.2, came in at 0.3. All right, the core services, this is without certain indices that would tend to spike it, okay? It's even higher. But in the long run, if you look at the blue bars, you see they're all coming down. Does this make sense now? So we want to see it just go straight down, not to zero, but close to zero. All right, so this inflation report is crucial as it comes just before the Federal Reserve's policy meeting on the 17th and 18th of September. That's next week. All right, the data that I'm seeing suggests that the Fed will likely implement its first interest rate cut in over 4 years. Now, market participants have waffled back and forth between 25 and 50. They're now saying they think it's going to be, when I say they, I mean the futures traders, 25 basis point cut. There's still some speculation that it could be 50 basis points, but I don't think that's going to be the case. I just don't think so, and here's why. 50 does not seem so nifty today. Why is this? Because it sounds as though hopes for this 50 basis point cut next week are taking a tumble, a big tumble. Why? Because this CPI had the potential to be a bit of an afterthought after Friday's jobs report. This is why I present this data to you. I'm letting you know what I'm thinking about on a day-to-day, sometimes hour-to-hour basis when we make decisions on the stocks that we buy for your portfolio. This is actual data that makes sense. I hope I'm not using word salads to describe what I think of the market. I'm giving you, here's the actual data that I am getting paid by you, right, to make these decisions. And I want you to understand it. The Fed is no longer solely concerned with inflation. The Fed's dual mandate also includes maximizing employment. So that means if employment is dropping and they're getting the inflation battle done, they don't want to kill the employment battle. Unlike most of the rest of the European Central Bank, the Bank of Japan, those central banks, they don't have the same dual mandate, at least not to the equal balance that the Federal Reserve does. And I think that that's wise. Hard to believe anything that a government agency would do would be that wise, but it is. It's a good balance between monitoring inflation and monitoring employment. All right. So food prices tumbling. This is a good sign. Look at the food price spike there in 22. So when you hear those on the right talk about, groceries is going in watermelons 3 times as expensive, just gas has been, and that's all true. Okay, but it is moving in the right direction. Yes, there's a little spike from 2 months ago, but look at where it is now. So overall, inflation is moving where we want it to be, and it's doing so despite the political environment. We want it to keep moving in that direction because we want a little bit of inflation. We want about 2.5%. The Fed's target is 2%. All right, but that's why don't be afraid of inflation. Just be afraid of high inflation. And don't even be afraid of it because I'm here to confer with you when I'm making decisions. Because we're gonna find a high inflation friendly portfolio. That's why if you look back at the performance on CGGI and DS, it's been pretty good, even in a high inflation environment. Okay. So don't sweat it. I'm going to take a little bit of an air break here. I'm going to let you guys type questions. Hey, Deb from South Florida, Democrats. Okay, yeah, I know. And I see, did I lose any viewers during my political rant? I lost 43% of my audience. Well, those of you that are still here, thank you for being here. I'm going to take a sip of water. There's about a 25-second delay. Type in the chat if you have comments for me. This is the time. Good to see you, Keith and Tommy. All right. Here we go, guys. Recession. This is one slide, okay? And it's really this simple. The start of a recession is heavily aligned with the first month when payrolls turn negative. Please look at this chart. The black line is negative. You see the dips below it. You see the gray bars going across, those gray vertical bars. Those are recessions. All right, we had a teeny tiny recession in 2020. I just laughed because it was a 6-week recession. It was the funniest thing. It wasn't funny at the time, all right? But look at where payrolls are going. We cannot have a recession with payrolls continuing to be strong. Enough said. Next segment. All right, the employment scenario. So this is a mixed picture, but in general good. So the unemployment rate edged lower. That's a positive. See that little bitty red dot there? It just moved down a little bit. And it has been mercuric this unemployment rate. And why is that? Because when you have these violent market moves and therefore recessions that follow, you have these huge spikes of 10% back in 2008, 2009, and then in 2020, it's off the chart. Okay? It's off the chart. So at any rate, in general, I think our U3 rate is pretty good. The survey was 4.2, came in at 4.2. The ADP, so this is the company that has the huge payroll entity, and you'll see that that's a little bit lower than expected there. So 145, the actual was 99. The survey 165, and the non-farm payrolls, this is the government number, not the private sector number, came in lower as well. So that's why we had a little bit of volatility. So it rebounded from August, but still fell short of expectations. But there's no huge shift going on here. All right, so the July report came in 8,100. The actual was 7,600, but you can still see the number of job openings are going down. But remember what we were talking about a year ago. We had 2.5 jobs for every one person. 2.5 jobs for every one person, right? So we're not there now, but we don't need to be there. That can be seen as almost a dire situation when we just have jobs waiting to be filled, but nobody to fill them. So now supply and demand are coming more into balance. All right, so this 3.5-year low as labor market eases, that's fine. We can deal with that. All right, so the underemployment rate, this is a little bigger concern. So this is nearing 8%. So what is underemployment? So employment, the 4.2. Underemployment are those people who either can't find a full-time job or want to work more hours, and they're only being offered 28. A lot of reasons companies do that is because they don't want to pay benefits. I get that. And somehow they're going to have to figure this out in Congress, a way to balance this out so we don't have people working 28 or 31 and a half hours, right? Or maybe 29 and a half, whatever it is, to be able to qualify for benefits. I mean, we want full-time people employed if they want jobs, right? We want that, all right? Every American should want that. And because of this, the expectation of losing your job is at a lifetime high, a record high, all right? Now, you can go back just a year or so and see a little bit higher spike there, but this is rising stronger and more logarithmically than I would like to see. All right, we don't want people concerned about losing jobs, and I know younger generation, right, than us, many of you watching this show, that are going, I don't want to lose my job because I work from home and now I'm living in Antarctica and I'm not going to move back to civilization. I want to stay here in Antarctica, metaphorically speaking, okay? I don't know what the Wi-Fi is like down there. So, but that's the concern that you're seeing from employees right now. Housing market, pretty straightforward. I mentioned I was going to show you this slide. So U.S. existing home sales rose more than expected in July, reversing 4 consecutive monthly declines. Why? Because there's an improving supply and declining mortgage rates. Let's read that again. Best month in 4 consecutive months of declines as an improving supply and declining mortgage rates. So when there is a bigger supply of homes, there's more competition. When there's more competition, it's better for consumers because the price wars happen. As a seller, and that would be what I am some point, not anytime soon, I don't want competition. I want to be the only guy on the block, so to speak. All right. But for the market, it's much better to have plenty of offerings and plenty of competition and lower interest rates. We're moving in the direction of lower interest rates, and that's what I've primarily been talking to you about, even in this Remember September show we are doing, all right? So, when we get to economic indicators, these are not entities, items, data points that are moving the market right now today, but these are what I'm watching to move the market in the next quarter, even in the first quarter of 2025. It's hard to believe we're already talking about that. So second quarter GDP was revised upward. Look at that big blue bar there. So that was an oops. And when they say revised, it's not like we're sorry, we got it wrong. So whenever a datum, that's singular of data, right? So whenever a datum is released, like GDP or non-farm payroll or PPI, producer price index, there is the initial month, and then there's the next month revision, and then the subsequent month revision. And then the month after that, they start with another quarter again. So there's always a monthly report. It's either the original, the first revision, or second revision, and then another original one after that. And it happens for all the major data points. So when we see a revision upward for GDP, that is a positive, very much so a positive. So as projected, U.S. retail sales actually exceeded expectations. You'll see that red bar jump above. Now, it's not going to compete with January 2022 because that's reflecting all the Christmas sales in that year. And actually, 2023 was kind of a down year for the Christmas market. But the survey was for 0.4% growth and the actual was 1.0. So what does this say? You've been hearing me say this throughout our presentations. The consumer in America remains strong, and that is a good thing. Even in the midst of political turmoil, not world war, but wars in this world, all right, and all kinds of reasons to say, I'm a consumer and I just have too much angst, I'm going to stop spending. It's not happening. It's not happening. That's why the earnings reports were at 79% beating, right? Instead of 73. You guys remember that chart? I show it to you every month. All right. So we're still seeing people spending. All right. Consumer credit surge. Now, this is a mixed blessing. The survey was for 10-4 and the actual, we don't have August data yet, 25.5. All right. That's just in billions of dollars. That's an astounding number. Now, I am not encouraging you to live a deficit lifestyle. In fact, I've spent my entire career telling our clients, do not do that. Do not spend beyond your means. It's one thing to invest. I had a client send me a great question this week, by the way. It's like, is there good debt? Is there good debt and bad debt? There absolutely is. And I want to thank you. He's a regular viewer. And I want to thank you for that question. And yes, there is. So if you are investing, if you're spending money and borrowing money even on an asset like a home, not a Maserati, but a home, something that's going to appreciate. That's why it's called real estate, because it's intended, sure, it can go negative on occasion, like those condos in South Florida that they had to basically shipwreck all of those because of that foundation situation. You remember that. But the point is, borrowing to build your asset base or buying on margin. Let's face it, you hear about investing in the stock market on margin, which I don't recommend, but you buy your house on margin. How many of us actually pay cash for a house? All right. We buy it on margin. We put up some money and we find someone else to basically work with us to buy this house. That is good debt. So when I see this consumer spending, it does concern me a little bit for the long run. And here's why. Excess savings continuing to go down, and the trajectory, look at the purple dots there, means that by the time we get to this point in 25, we're going to be negative. And that definitely concerns me. We're not just going to be not saving. We're going to be drawing on our savings and they're going to go negative. And it's because our consumption spending on the right-hand side is at lifetime highs. The graph only goes back to 2017, but I assure you it's much higher. It really takes a lot to bring down the American consumer. COVID did it, 2000 did it, 2008 did it, but it doesn't last. And this is why I have never been a perma-bear, permanently bearish, okay? Because the American consumer is 68% of our economy, and they are the most resilient force on the planet. The U.S. consumer is the most resilient force on the planet. It's just that simple. And they are not going to be dissuaded for too long. All right. So AI, just a couple things I've seen that I really thought interested me. So is the eye the window to Alzheimer's? This is a new technology that basically is doing a retina scan that apparently could go back in a 3-4 dimensional scale. And as hard as this is to believe, look for heredity and find, I mean, it sounds crazy. You guys can Google it and find it. It's out there. It's on Perplexity or other sources, okay? And I find a lot of these sort of things on Perplexity. Not an ad, by the way, but you'll start to see, if you look in the credits down at the bottom of the sources, a lot of Perplexity, because it is a multi-threaded generative AI engine. And they are now able to look at history of the retina and a person's eyesight, etc., and the connection to the brain, and predict the proclivity, there's that word of the day again, for this person to have Alzheimer's. This is just in the beginning, but when I see these kinds of articles, I get ideas like, who's investing in this? Where are the companies? Are they IPOs? Are they small, micro cap companies? I have no problems. If you look in your CG account, you will not see this in GI. You might see it in DS, and you definitely will see it in CG. These micro cap companies are going, what's he doing buying a $3 stock? And I'll answer that in just about 8 minutes, okay, with a very specific example. All right. So another thing I've seen, confronting your fears in virtual reality therapy. So one of my best buddies and client is a psychologist, and we're talking about being able to put on these virtual reality headsets. So one of my children works for Meta. You guys may remember that. And he ships these headsets all over the world. I mean, that's his job, is finding the most expeditious way to ship them. But imagine getting over things like, in my case, I have a terrible fear of claustrophobia. And I know other people, my best friend has the same challenge, okay? But imagine being able to immerse yourself in this sort of technology and being, put into a stopped elevator or something like that, where there's no actual harm, and where if you have to, you can throw it off your head. But I'm just seeing, just within literally months, 2 years ago, none of this existed. But now to be able to help us with psychological challenges, and of course, as your portfolio manager, I'm looking for the investment opportunities in these new technologies. I find it really exciting, and feel free to check them out and let me know if you guys see anything that interests you. So we always finish with the investment methodology. This has been an interesting time. It is September, as you well know by now. Our 3 programs, CG, GI, and DS. So capital growth and income, discretionary strategies. Every single one of our clients has a capital growth account. About 60%, maybe 70% by now, have a GI account, and about 20 to 25% have a DS, and I'm expecting that to double by this time next year. By the end of next year, almost half of our clients will have a DS. Even look at the red lighting there, with no stop loss risk. In other words, we do not have a stop loss management strategy employed, making the program very volatile. Why would we do that? Because if we had a stop loss methodology, it would be like our other programs. A stop loss methodology, and I've shown this on many shows. Again, my video production team, Tommy and I, are working on extracting previous episodes where I go through why not having any stop losses will give you a greater return, right? Because the market always comes back. But how much pain are you willing to go through waiting for it, and how much time, pain and time, equals time for recovery, right? So I've told you that before. I'm not going to spend time on it now, but watch for those extracted excerpts that you can refer to. So CB3's benchmark accounts are valued around $300,000. So we have multiple accounts in our family office, but the CG benchmark, a little higher than that now actually, but that means a 1% stop loss on any position. Okay, so on any given risk position, $3,000, it has, the price of the stock has no bearing. I don't care about the price of the stock, neither is the number of shares purchased. If we have 100,000, and this is 300, but just easy math, right? $100,000 account, and I decide to buy ABC, I'm going to risk $1,000 because that's 1%. Doesn't matter about the price of the stock or the number of shares. I'm going to risk $1,000, and if it hits that stop, it's gone. Doesn't matter if I like it. Doesn't matter if mom said never sell this. It's gone. Okay? It's a mechanical, systematic approach to risk management. All right. So I've shown you this before too. I'm trying to make this a little larger. Alice was trying to extract it, and I know there's a ton of data here, but I'm highlighting what's important. So when you have a system like mine, the profits are going to be bigger than the losses because the number of wins are going to be less than the number of losers. So I hope you can see this biggest profit, and I'll show you these on the next page. So far, since we've been using this methodology just a little over a year and a half, biggest profit, 11,551. And sidebar on this. So why is it only a year and a half? You've been doing this 30 years. Because the technology didn't exist. We couldn't do this analysis, okay? We just couldn't. Maybe Goldman Sachs could, but we couldn't, and now we can. And that's cool. Very, very cool. Biggest loss, 2,800. Profit loss ratio, that's 2.82 to 1. So that means almost 3. We actually dropped a little bit. We've had some losses this summer. It's been kind of a choppy summer. But almost 3 to 1, 2.82. In fact, the last time I showed this to you, I think it was right at 3. All right. So look at the returns. The winning trades, 38%. The losing trades, 61%. Now, I've said this before, but in baseball, if you hit 333, you're a $50 million player. I mean, you're a $50 million player, and yet you strike out or ground out or fly out 2 out of 3 times at bat. So as long as you really do something substantive when you do get a hit, then you're going to be fine. And we do. Our biggest profit percentage, okay, 161, almost 2%. Biggest loser, only 35%. How does this look on the chart? So April 2023, I should say, this management system has been enforced, and here are the top 16 winners and losers. So every day the equity in this account rises and falls. So currently today, it's 324,600. All right, and that means a 1% risk is $3,246. R stands for risk, or 1% of assets under management in this account. So look at the winners. You'll see Alpine, SMCI, VST, etc. The point of this is that those are pretty good sized winners. And look at the losers. And yes, I know, Wolf Camera was my worst loser for almost 2 years. And just a little bit bigger than that, IMMR, which is a biotech company, and SLQT, same thing. And that's because they blasted through their stops. Now, did they lose more than 1%? They did not, okay? And that's because our stops are tight enough to keep it within check. So if you look at the math, 3,246 on the risk, and look at those worst losses, 27 and 2,600. Now you might say, well, gosh, I lost more than that, or I lost less than that. Well, of course you did. I have some clients who have bigger CG accounts than my benchmark, because we also trade CG in our trust accounts, analysis accounts, right? You guys get that. So, but when I have everyone on the same trading block, we're all percentage-wise sharing the same amount of risk, obviously in our individual accounts, right? So don't be concerned about that. But that's how the 1% plays out, and it's working for us. So I get this question all the time. Just look at this chart for a minute, okay? And then look at the 2 stops over there. So people will say, you know, I wish you would not just follow the stop. Sometimes you just take profits. Well, actually we do. And this isn't the first time this has happened, but this was a crazy example this week. This is Summit Therapeutics, okay, SMMT. So I bought this, and you can't see the calendar on the bottom because I wanted to be able to show as much as I could on here, but around $4. Okay, and it just kept rising and rising. These are weekly bars, by the way. This isn't on a day. This is a whole week. And you see that spike, and it's like, oh, okay, somebody's doing something there. I need to pay attention. And then nothing happens for 6 days. And then crazy, what happens? Their experimental drug, I can't even pronounce this, Ivanoskicab, outperformed Merck's, okay? And the minute that happens, look at this bar. It's insane. Now, markets react to this kind of news in a way that there's nobody fast enough to push the button, all right? Nobody fast enough. And that's why your stops have to be in the market and your buy orders have to be in the market, because you can't predict this, especially when you're managing a portfolio with 33 stocks, which is what CG is. So when we had this huge spike, as you know, I think you know, let me go back to on camera here. We have 33 stocks at 3% equals 99% in CG. Again, all of you watching that have accounts with me have a CG account. 1% in cash. There are times when I have more cash when the market's really stinking, all right? All right, but right now we're fully invested. So what happens is when this monster of a move happens, this particular stock took on a 3.5%, 4%, 4.5%, 5.2% of the portfolio in a day. In a day. Okay, so what happens is I go into the market and I sell. You see the sell up there? All right. So I sold us back to 3% because I did not want to have more risk in the portfolio in one stock, because then I'm ending up managing a stock position instead of a portfolio. All right. So the next day after that, the market continued to go up. Again, this is a weekly bar. Now you could say, well, why'd you sell so soon? Well, because the market was trading at $20 when I bought it at 8 and I didn't want that much risk on the table. Yeah, but it's 27. Okay, but what if alternate news had come out and now it's trading back at 4? I'm not going to take that risk with your money. If the market is going to give me a 60% return, which is what it was the first day on that stock, I am taking some chips off the table. And if I don't, you need to fire me. I mean, that's just the reality here, okay? You just got to do it. So what happened today is that it went up another 20-some percent. Another 20-some percent. And so what did I do? I went into the market again and I sold some more. Look at this chart. Just take it in here. All right. So that's how we do things. That's why we make the decisions that we do to reduce risk in your portfolio. Look at that. You're not going to see these kind of moves that often. Okay. So here's capital growth, CG, for the year, the blue line. 23.7 is actually much higher than that. That was 2 days ago, but I couldn't get today's performance. I didn't have time. So we're well over 25% on the year. We're beating all the other indices that we follow, the EFA, which is the European markets, the Vanguard, and then obviously the S&P as well. So we're happy with that. GI also having a good year. Remember, there's only 60% stocks in this portfolio, 60%. So that it's doing this well. And really until June, it was beating the S&P, even only as a 60-40 portfolio. But with the market just continuing on fire, it's really hard to keep up with that. But most of my GI customers are really happy. And that's because you can see the drawdown. Look at up in the right-hand corner where it says max drawdown, 11% for CG, only 5% for GI. So it's less volatile with a respectable return. And then you've got DS, which is just all over the place. And it's been this way for right at 7 years, okay? It's underperforming right now because the trillion-dollar companies have underperformed in the last quarter. And you can see that blue line just killing the market and then plummeting after July. So this whole third quarter, they have been stinking. But am I concerned about it? I am not. Look at the date on this, September 12, 2017, September 10, 2024. We are almost at a 7-year track record, and I expect it'll be close to 300%. Now, is DS for everybody? It is not. But if you can take the volatility and you want these kinds of returns, should it fit into a mix of CG and GI? More and more of our clients are finding that out. We have no clients that have just a DS account. I wouldn't do that because it has to be part of an overall mix. That's an asset allocation issue, which is not a portfolio management issue, okay? But just explaining that to you. All right, guys. All right, that was the show, all right? Remember September. It's going to happen every year. There's going to be drama. There's going to be histrionics. At least there won't be a presidential election now with debates in September for the next 4 years. But it's just the way it works. Our next show, October 10th. All right. Did I miss any questions here? I'm going to take a breath and see what we have in the way of questions. Is there another country you think would be a better place to live and invest? That's a great question, Deb. I will reveal that answer. I have looked at Lucerne, Switzerland, and here's why. Because it's the home of classical music. Arguably, Vienna, Austria is as well. But from a cultural perspective, the mountains, the quality of life, not a whole lot of political strife. But would I pick up and move? No. No, we're here. We have family here. We have lots of great things here. I still have hope, and I still have faith that this country is going to come back from just the incredible acrimonious time that we are going through right now. And Dr. J seems to agree with me. In Russia, the unemployment rate is really low, 2%, because most of the workforce is now in the military. That's great, Doc. Yeah. You know, and of course, this is the way it was for World War II. We didn't have unemployment in World War II, did we? Well, of course not. No countries did. They had a lot of other problems, a lot of caskets. I don't mean to downplay that. Forgive me, please. But you see where I'm going with that. There are worse things than having high employment. unemployment, I should say. I would not want to be in Russia, and the egregious there, guns versus butter, that's exactly right. So guys, if you're not following me on the podcast, please do that, okay? Because why? Because you can see me now, you can see me on this monthly show, you can see the podcast weekly, usually 2, but always 1. Okay, and then daily tweets. We're doing that, all right? I'm trying to get out there to reach you, to let you know, A, I'm your portfolio manager. You're paying me to watch the markets and invest on your behalf. B, I want to encourage you with what I'm seeing because I still perpetually believe, I'm a perpetual optimist about the future of America and the American markets. There will be dips, there will be downturns, but overall, there has been no better place to invest in the world. And how can I say that with confidence? Simply go back in your mind or flip back when you watch the show the second time, like all of you do, right? Watch that 100-year chart. Watch that 100-year chart, and you'll see that with dips and turns, it's still straight up over the last 100 years. In summary for tonight, as I have said every show for the last, 5.5 years, right? For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. That is from Timothy, 2 Timothy 1-7. Guys, I hope this has been helpful. And again, my mission is to edify, educate, and to some extent entertain. All right, that's what we do here on CB3 Live. Our other programs are meant to sustain you between these monthly shows. Please tell your friends. If you know someone, and we're not looking for more clients right now. I mean, would we talk to somebody? Yes, our book's been closed for many months now. But we're happy to talk to people that might be frustrated with their manager that is not keeping up. A guy comes to me from California. I was just out in LA. And says, I got this advisor, I'm paying him $14,000 a year, and he calls me once a year and says, here's what's going on. And that's it. And it's like, well, this is what our clients get. And so it kind of raised an eyebrow. And we're doing it just because we know that there are so many forces out there that are discouraging people about investing for the long term. And that's just not us. We believe you should be investing for the long term, but not stupid about it, not just wholly. We don't make decisions based on intuition or even intuition. We have a systematic approach. We will protect your money on the downside when we see the markets failing. And that's just what we do. We've been doing it 30 years. I don't know if we're going to do it 30 more, but we're going to do it 15 or 20 more. And I hope each and every one of you is with us during that time. May God bless you. And remember, at CB3 Financial, we don't just manage your assets, we become one of them. And for those special people out west, we will see you next week in South Dakota. And the rest of you, we're coming to your hometown sometime soon. God bless. We'll see you in October.